All right, thanks everyone for joining this segment. For this short session here, we're going to be talking about cash flow analysis. But first, my name is Ben Ribbe. I'm a commercial lender at Mercantile Bank. Excited to talk to you guys about this today. Yeah, so like I said, what we're going to be looking at today is cash flow analysis. Really big picture. This type of analysis is at the absolute core of the bank's decision making when we're deciding whether or not to give loans to customers. This is what we're looking at to make those decisions, because ultimately what this tells us is, are those customers who have debt from us able to pay that based on the income they're generating from their business? So at the end of the day, if they're not able to pay the loan because they aren't generating enough cash, that's not something we want. So our goal with this analysis here is to determine, is that business able to pay their debt based on the income they're generating in the past? So ultimately, this is a really big topic. You can get really in depth, but at the core, it's pretty simple. We're just comparing how much money they make to how much debt they have and making sure that those two things align. So what are we trying to do with the cash flow analysis? There's really two sides to the equation. On one side of the equation over here, we have cash generation is what we'll call it. This is the company operating on a day-to-day basis, selling things, making money. And then on the other side of the equation, there's debt. And that is what they've borrowed that they're required to pay by the documents they sign, and legally they're required to pay those. So those are the two sides of the equation: how much money they make and the amount of debt that they have. So ultimately, what this analysis does is compare how much money they're making to the amount of debt they have and make sure that they're in balance. Because if we have a situation where they have a lot of cash coming in and not a lot of debt, we're in a great spot because they're able to pay it. If there's an inverse situation where there's a lot of debt and not a lot of cash to pay it, obviously that is not a good setup and there's going to be problems. So ultimately our goal with this analysis is to make sure those two things are in balance. So what we're going to do here is, that's a quick introduction to the cash flow and some core concepts. What I'm going to do is walk through an example of how we go through a cash flow analysis. And then after we go through that, we'll look at the results and kind of see what those tell us. And then go through a couple ancillary what else type of situations. But that's kind of the goal. So let's dive right in. What we have here written on the board is an income statement. So for the purpose of this example, let's pretend that this is a manufacturing company that makes LED lights for cars. So their company has little lights that they then sell to Ford and GM that go inside the car, the little light on the roof. It can even be headlights or whatever you want it to be. So this would be their income statement. We'll call it their 2020 income statement. They did really good during COVID. So on the top here we have revenue. This is obviously how much they're selling to Ford, GM, whoever their customers are, how much money they're bringing in. Cost of goods sold, this is how much money their parts cost. The difference between those two is the gross profit, essentially the initial how much did they make on those pieces before paying all their other expenses. So as we keep working down, 15 minus 8 gets us to $7 million of gross profit. Minus their operating expenses, this will be things like utilities, this will be paying their employees, their salaries, all of those sorts of things are in operating expenses. So that's what we're capturing here. So we keep working our way down. We get to pre-tax operating income. This is their gross profit after taking out their operating expenses, gets us to their operating income. So as we go down farther, we have their interest expense. This is what they're paying on their debt obligations, just in interest. And then this company here has a loss on sale. So we'll say they have an equipment that places the light bulbs inside a piece of plastic or something like that. And they didn't want that piece of equipment anymore. They upgraded. They sold it for a little bit less than it was worth on their books. So they recognized a loss on the sale. So now their pre-tax income minus these two items gets you to a net income before tax. This is essentially the summation of all of their operations. This is what they've done as a business in that year. So what we're doing with the cash flow analysis is taking this income statement, the history of how they've performed, and applying that to figure out how much cash they're generating. Because as you guys know, mixed into the income statement, there's items that are non-cash. So things like depreciation. This is something that they're legally allowed to do for cash purposes or for tax purposes. It's something they do to track how their equipment is, how old their equipment is, and if it's still useful, if it's getting to the end of its life and they need to repair it. But that's not actually something they're writing a check for and paying cash for. So what we're going to do is take this income statement that has some of those nuances built in and figure out how much cash the company is generating that it will then be able to use to pay its debt obligations. So let's dive right in. So what we're going to do here is we're going to start with the net income before tax in our cash available column. So we're going to take that $5.2 million. These numbers are all in thousands. That's what bankers do. And we're going to assume a tax rate of, let's say, 40%. There's a lot of different opinions on what tax rate we should use for this analysis, but 40% is generally accepted and conservative. So we're going to take out 40% of this just in taxes because we got to pay the government what they're due. And that is going to equal $2,080,000. So we're going to take that out, and this gets us to a net income number after taxes. So that totals out to $3,120,000. So that's after they paid their taxes. We have to take taxes out because they're required to pay those even before they're required to pay us what we're due on our debt. So next we're going to talk about those non-cash items that I talked about. So because they are non-cash and we're trying to get how much cash they generated, we have to give them credit for those and add them back. So let's pretend in operating expenses here we have depreciation expense built in of $750,000. Say $750,000. And we have amortization expense of $750,000, both non-cash items. So what we're going to do is we're going to apply those to our cash flow and add those back. So let's add 750 here, 750 here for depreciation and amortization to get us to a total there of $4.620,000. So now that we've added back those non-cash items, there's a couple more things on the income statement we're going to want to apply to the cash available figure. One of those being interest expense. This one's a little bit tricky because this is something they're paying in cash to us, the bank. That's the interest expense that they're paying on their debt. But because we're going to be capturing this on this side of the equation, because that's part of what they need to pay on their debt, we don't want to double whammy them. We want to give them credit for the interest that they're paying here, and then we're going to account for that on the debt side of the equation. So what we're going to actually do is add back interest expense here of $200,000. So now we've given them credit for their interest expense. There's one more item on here that we want to address. This is the loss on the sale. So when we're thinking about the core performance of a business, sometimes there's one-time items that occur throughout the year. One of these being a loss on a sale. Because, for example, a business doesn't sell its equipment every day because they'd have no equipment left. When they do sell a piece of equipment, this is a little bit one-time in nature. And so if it is one-time, that's not core to their business, and that's what we're trying to analyze here. So we're going to give them credit for this loss on sale by adding back $100 or $100,000 of loss, because this is cash that they would not normally spend in a normal year. So the total of all those gets us to what we'll call a cash available of $4,920,000. So that's our total there. If you can't see that because of the board, we'll put it right here too. $4,920,000. This is the amount of cash that the business has generated in its operations to pay its debts. That's a very important number. So now we've essentially taken their income statement, gone through our analysis to figure out how much cash this business is generating on an annual basis in order to pay its debts. So now let's jump over to the debt side of the equation. So as Patrick talked about in a previous video on types of loans and loan structure and loan terms, we're going to apply some of those to this fake manufacturing company. So let's assume that this company has a revolving line of credit, essentially like their credit card for the business. And that line of credit is $1 million. And it has an interest rate of, let's say, 6%. And as Patrick talked about in his video, a line of credit requires only interest payments. They pay back and can draw on the line of credit as they want to throughout the year, but the only required payments are the interest. So what we're going to do here is calculate how much interest the bank is requiring them to pay on the line of credit. But in tandem with this, we want to be conservative because banks are always conservative. And in regards to the fact that interest rates are currently rising, we want to make sure that we put in some sort of buffer because this is a variable interest rate of what may happen if rates go up. So in order to be conservative, we'll add 2% to that rate that they're required to pay, and we'll assume their line of credit requires 8% interest. So at that amount, on $1 million, we're going to assume that the line is fully drawn throughout the year because they're able to draw the line fully. They don't have to, but in this scenario, I want to be as conservative as possible and assume they've drawn $1 million for the entire year. So taking that $1 million times 8% annual interest rate obviously gets us $80,000 of line of credit interest. That's required. So that's the line of credit. That's what they're required to pay for the line of credit and interest. Now let's assume that this company also has a term loan, which Patrick also talked about in his presentation. And let's assume on that term loan, they are required to pay $1 million a year. I'll just make that number up. In both principal and interest, because just like if you had a car loan or your house mortgage, you have monthly payments that you're required to pay. So every month you send the bank a check or they take it out of your bank account for, in this case, if you're the company, $1 million a year. So that would then play out in monthly payments. So let's assume this includes both principal and interest. So this term loan requires $1 million a year. So now we're up to $1,080,000 a year of required payments on their debt. And because we're looking at this company, they're at the table talking to us about what they need. They now want to buy a couple new machines, a new forklift maybe, and they're looking for debt to finance that. So let's assume they need an extra $6 million in debt in order to purchase the fanciest forklifts on the face of the earth. And we're going to give them that debt, and it's going to require, just like this one required $1 million a year, we're going to say this new term loan requires $2 million a year in debt service. And that'll come through in monthly payments just like this term loan did. And it'll match the useful life of the piece of equipment. And it'll pay down fully as we think that equipment is useful for. And Patrick also talked about that in his presentation. So now this is what the company has as far as debts. They have their line of credit, which is they're required to pay $80,000 of interest on. They have their term loan that's existing that is paying it $1 million a year, and a new term loan that is going to require $2 million of total payment. So all together, these equal $3,080,000 of debt. Required payments by us and legally that they need to pay on their debt. So now we've calculated all the numbers we need to know. What is that? What do we do with it now? So what we're going to do, as I talked about before, we're going to compare the cash available that the business has generated to the amount of debt that they're required to pay. So that it's simple math. You take the cash available for debt payments divided by the amount of debt that they are required to pay. And this will give us what we call a debt service coverage ratio. And this is what bankers everywhere use to determine whether or not, or how well a company can pay its debt obligations. So, correct me if my math is wrong, but I have a total ratio here of 1.59 times. So what does that mean? If these two things were equal and they were generating the exact same amount of cash that they needed to pay their debts, that ratio would be 1 to 1. So anything north of 1 to 1 is good. That means they're generating more cash than their total debt required payments. On the other side, if that is lower than 1 to 1, that means they are not generating enough cash through their operations to pay their debt. And that's a situation that banks and customers never want to find themselves in. If we come back to the table, do we need to restructure the debt? What are the ways that we can help them? So big picture, that is what the analysis tells us. It gets us to a final figure that we call the debt service coverage ratio. So now that we have that, and we kind of know what it means, that's healthy, that business is doing really well, they're generating enough cash to pay their debts. What are some things that we also want to think about? Well, this is 1 year. This is a pretty static analysis. Let's say this is 2020. Well, what happened in 2018? What happened in 2017? What happened in 2019? Is this a really, really good year? Is this a really, really bad year? Those are the things we want to think about. So what we as a bank usually do is we'll look at, say, 3 or 4 years of historical periods to analyze the trends. Maybe it's steady and this is how they always perform, and it's really trustworthy that that's how they'll perform in the future. If this was an anomaly, this is a really good year, maybe we'll want to consider that in how much debt they can afford. Maybe we want to assume they don't perform this well and we might not give them as much debt. So those are kind of the things we're thinking about by just looking at this ratio. We also want to think about it historically. So that's kind of the summary of cash flow and what we do. How we look at it on a historical basis is really important. There are a couple quick things to consider that a cash flow analysis is not perfect in. This is their income statement, this is their core performance, but there's some things that cash is spent on that are not captured in the income statement. So think of things on the balance sheet that might require cash that don't flow to the income statement. This could be things like, say the owners of the company make a distribution and they take cash out of the business. That's not captured on the income statement, but that's cash they no longer have to pay their debts. This could also be things like capital expenditures. If they buy a new piece of equipment with cash, that's not an expense, but that is something that they're using cash for. So things like that we want to consider. There's obviously more in depth you can go into cash flow analysis, but this is the high level of how banks look at it, how we calculate it, and what it means. Thanks.